back. Just was taking a look at Just Dial. While the stock is up 1% today, it's practically halved ever since Reliance Retail Ventures had taken stake in the company a couple of quarters ago and had put in that funding of 2,200 crore. When Reliance Retail acquired the majority stake in Just Dial, it was done at a price of 1,020. As we speak, the stock is now down to 575. So clearly that, it's not done very well after the Reliance Retail investment has taken place. The company is looking to transform itself. So it is a work in progress. They've got a lot of new initiatives like JD Mart, which is the B2B business, JD Shopping, which is a B2C, business to consumer buy and sell, something like an Amazon or Alibaba. And they also have JD Experts, which is equivalent to your Urban Clap, which is on-demand service providers. They need to integrate all that, get in the Reliance retail expertise as well and synergies from that, but it's still yet to play out. And right now I was just noticing that the stock price at 575 is practically half compared to the Reliance retail investment, which was done at a price of 1,020. That's Just Dial for you. But let's talk about the markets. We're up, holding above 16,300, extending gains for the third day in a row. Varun Goel of Nippon India AIF joins in to discuss the fundamentals of the market. Varun, morning, and thanks so much for joining in. Was just taking a look at some of your portfolios. In the India Millennial Fund, you've got an investment in Mindtree. I think in the $5 trillion opportunity, you've got an investment in eClerx. So you are fairly bullish on midcap IT, and midcap IT has plummeted. What have you done with your holding in the last 6 months, as we've seen the stocks correct about 40-50%? And what is your call now on midcap IT?
Good afternoon. Thank you so much for having me on the show. I think, yes, midcap IT has seen significant correction in the last 6 months. I think the valuations have become much more palatable. I think we see the IT capex cycle, which has been playing out for the last 2 years. I think this has much more legs. Be it any business now, whether it's manufacturing, whether it's financial services, it is important that every business has a digital presence so that every customer can avail the products or service in a virtual environment, and therefore we believe this IT capex cycle will continue for the next few years. After this recent correction, I think most of these mid-cap IT companies are trading at 1 year forward multiples of around 23 times, and with the earnings growth potential of 15 to 20% at least for the next 2 to 3 years. So in our view, with good clean balance sheets, high ROEs, good dividend payouts, they remain very attractive bets, and we continue to hold on to them for the next few years.
Okay, continue to hold on to some IT names for the next few years. Varun, good morning. Thanks for joining us. This is Pavitra. The other space that I see where you are quite positive is the auto space, and we have seen, of course, that entire pack do quite well in the recent past on the back of demand, which has been picking up quite strongly. So take us through how you would play the auto pack, and if there are any select names that you would recommend within this space.
Good afternoon, Pavitra. So I think 2019 was the year that auto industry saw the best growth, and since the last 3 years, the auto sector has been struggling. I think 2-3 reasons for that. One is the prices of the vehicles went up significantly. There has also been a lot of inflation. We have seen the rural demand struggle. Therefore, the two-wheeler sector in particular went through a downtick. I think even now at this point of time, while the rural demand continues to be sluggish, it is the urban demand which has been doing quite well. So we remain quite positive on the four-wheeler space. I think companies which are geared towards the electric vehicle segment, companies which are launching models which are able to get funding as far as their four-wheeler EV stories are concerned, should continue to do well. We are also seeing SUV segment continue to do very well. People are moving or upgrading from hatchbacks to more powerful cars, bigger cars, and therefore companies which are able to bring credible offerings as far as SUVs are concerned should continue to do well. So our play would be on some of these OEMs and select ancillary companies which are geared towards the EV story.
Hi Varun, morning. This call that you have on real estate, what is the kind of time frame that you're looking at? Because with this fears of a recession looming, I'm certain that real estate will be one of the first sectors that sort of feels the pinch. So is this like a very long-term call that you have, or is it more tactical in nature?
Well, I think if you look at the real estate cycle, we typically have the way we have seen cycles play out is 5 to 6 good years followed by 5 to 6 bad years. This cycle we are seeing particularly peaked out in 2012, and since 2012 to 2020, the real estate sector, especially the residential real estate, went through a downtick. Affordability, which had become a major problem, is now at a much more reasonable level. So if you look at EMI to take-home salary ratios, it had gone up to 50% in 2012, and today it's around 33%. So which means that despite the mortgage rates increasing, affordability is much higher. So while we are not expecting any recession in India, globally, yes, there are concerns on recession. What we could see in India is some kind of a growth slowdown, let's say from 6.5–7% to maybe 5–5.5% next year. But even in that environment, we believe residential real estate should do well, considering the fact that we haven't seen prices doing well for a long time. There is a lot of pent-up demand which is coming, and more importantly, there is a big trend of shift from unorganized to organized which is playing out. The top 10, 15, 20 developers on a pan-India basis have seen significant improvement in their balance sheets. Corporate governances have improved, and therefore we believe that they should be able to gain market share. We are already seeing price hikes happen. The various data points which are coming from quarterly updates that various listed players have come up, they have shown very, very strong sales traction, and we believe this trend should continue. So we remain positive on the residential real estate space for the next 2 to 3 years. This sector was obviously one of the best performing sectors in the last 18 months, and we believe this trend could continue a little longer.
Okay, this is actually a theme that we have been discussing, and a lot of people have been echoing this opinion as well, that the real estate pack is likely to stay strong for a little bit longer. Varun, you're also quite positive on the financial space. So tell us how you would approach that sector. Is it the private banks that you would look at? Is it the public banks? And if someone is to put fresh money to play, do you think it's still a good time to get into these banks?
Well, I think as far as Nifty is concerned, one of the most attractively placed sector today is the financial services. I think earnings growth is going to be extremely strong for the next 2 to 3 years. I think for the first time, we are seeing such clean balance sheets as far as Tier 1 banks are concerned. Most of them have enough capital. Most of them have seen change in leaderships. We are already seeing a very, very strong retail lending cycle with mortgages, personal loans, credit cards also doing well. And now we see fresh signs of early stage, you can say, of revival as far as the capex cycle and the corporate loan cycle is concerned. If you look at the recent RBI data, credit growth is inching up. The latest data shows the fortnightly growth at around 14%. So I think with the excess provisioning done, the credit cost should remain low. Loan growth should be strong. We expect margins to expand slightly, considering the fact that the liabilities will reprice slower than the asset repricing. And therefore, we believe Tier 1 banks, both public and private, and select NBFCs should do quite well for the next sector.
Okay. Varun, since if this is a good time for bottom-up stock picking, what are the new themes that you're now looking to explore?
Well, I think there is a lot of froth which got created last year in terms of new age companies, tech companies, e-commerce companies. I think what is happening now, there is a recalibration of the business models, the valuations that companies are looking to get themselves listed is much more reasonable. So we believe that there are much more attractive opportunities as far as the overall tech platforms and e-commerce space is concerned. So that is one area going forward that one can explore. Selectively, we would believe that mid-cap IT would again get attractive. Select mid-cap pharma. I think those are spaces which have got badly beaten down. With the rupee at 80, I think anybody who's exporting should see a significant benefit on the margins. So that and select chemical space, which again had got massively re-rated last year, is down 40, 50, 60% this year. Those are the spaces where we would look to do some bottom stock.
All right, Varun, thanks very much for dropping in today. We'll leave it at that for now, and we're going to take a very quick break. Up next,